Hello, and welcome to Fireside with VC. My name is Andrew Romans, and I'm very happy to have my old friend who I've known watching his entire VC career unfold before me in the world is Nicolai Wadstrom. Nicolai, good to see you.
Good to see you. Thank you for having me.
So Nicolai, I want you to give your own background because it's too much for me to say, but I think General Partner, co-founder of BootstrapLabs, which is an artificial intelligence venture capital investor based in Silicon Valley. Nicolai, why don't you give a quick background of what you did before and when you started with Benjamin pulling together BootstrapLabs?
So put me in box. I'm a kid that learned how to program when I was very young. And by 15, I made extra money building software. And by my early 20s, I dropped out of university to build a real company with co-founders. So that was kind of too fun to not keep doing. So I spent most of my life as a technology entrepreneur, building one thing after another. Some worked out, some did not. One went public. Went through different areas from enterprise software to computer games. We did virtual reality in the mid 90s, different time, expensive silicon graphics machines to make that work at the time.
Okay.
And then over the years, I started to do angel investments, I think 2004 maybe, in parallel to this. And after a couple of years of that, it went really well, but I also realized that I wanted to build something more of a platform doing this. You know, one person is not an army. And I guess this entrepreneurial, drive kicked in for the venture aspect or investing aspect of what I was doing. So I decided to launch BootstrapLabs in San Francisco 2008. And been building it up since then.
And actually, by the way, you give away your age a little bit when you talk about a SGI box, the old purple Silicon Graphics Jim Clark thing. But so was it just you and Benjamin originally?
No, it's just me originally.
Oh, just you in 2008. Okay.
Yeah, and no external investors. It was my money. I took from the company went public and other money I made all in. Build an investment model that way, and felt pretty good to not have other investors involved. Actually, to be honest, I have raised a lot of venture capital for my own companies over the years. A lot of things to figure out, and I was, even though I had American roots, my grandfather was an American, but I grew up in Sweden, in Europe. So I moved across the globe trying to do something new. Even though I spent a lot of time in the Bay Area over the years before this, it was a lot of new things. So it felt good to be just focused and not have a lot of investors and others involved at that point. And then over time, it grew. Ben, a really good friend, there was a great juncture a couple of years into it for him to join in a co-founding capacity. And then we've been building since then together. And then
So when did you join forces with Ben?
So Ben joined, I think it was 2012.
2012, okay. Okay.
And then 2015, we decided to both focus solely on artificial intelligence, but also build more institutional type venture capital funds. We figured out a lot of things. We built a model and a network to drive a lot of value to support entrepreneurs, which was, being an entrepreneur, one of the key things why I'm doing this at all was that I wanted to create the best partner for great entrepreneurs to build great companies. I wanted to create the partner that I would like to have as an entrepreneur. So we worked pretty hard on figuring out a lot of things in the beginning in those years and worked quite well, but we also realized we were building too small exposure to what we're doing. So we need to build a little bit larger funds and more scale to what we did, and hence a little bit more institutional type venture capital funds. And then from then, we kept investing in the AI space. This was early, before there was a lot of buzz around this. We also launched a conference where we brought this larger community that we're building together, so kind of the tip of the iceberg, once a year, the BootstrapLabs Applied AI Conference. And building this out, the model work has been working incredibly well of driving access to deal flow, to talent, and the thought leadership model through the conference and the community really helped differentiate us, I think, of driving both access to talent and deal flow. And now we are.
And can I just jump in, because I think a lot of your story, or a successful fundpreneur, it's cool for entrepreneurs to hear about it, or people that are thinking if they were to leave their venture firm or start one from scratch? Are there any, actionable things that are repeatable that you've done with the event that you're doing, the Applied AI event? I thought you were doing that before the fund. Was that before the fund, or did you started raising LP outside other people's money first, and then the event became part of your?
We had a blind pool before we launched the conference, but we decided to focus solely on AI. And actually, we started raising that fund, and at the same time, we realized that there was actually no conference around AI that talked about how it was being applied and how that impacts society, organizations, and people. There was a lot of great places to go, like NVIDIA had their tracks of get together and to talk about how you build machine learning models. There was NIPS, there was things like that, but not how it was applied. And even those conferences were small because it was not really a mainstream buzz around AI. It was pretty niche.
So how many people were at these events? And I thought you were doing it more than once a year, but maybe you had some smaller ones.
Yeah, exactly. So we have the annual conference. It's small. It's 500-600 people. We kind of cap it at that. It's a TED-style conference.
Okay.
And then this is when there's not a pandemic. We've been really mindful. We don't want to make a poor online version of these conferences and events, but we've been doing the annual one every year. As you've been there a few times, so you've seen it, and then every quarter we tend to do a thematic focus, AI being applied into certain one of these core themes that we focus on, and that's been going. And during the pandemic, we didn't really do these types. We did other formats virtually that work well, more informal things.
Okay.
So, yeah.
Okay, and I didn't want to cut you off. I just wanted to jump in and understand, how you blended events. I mean, like in China, events is part of the playbook on every VC on, getting domain expertise around the buzzword that they've been offered capital for, and being the center of a super node in a network that is all whatever the buzzword is, that there's money available to those, emerging managers. So I always thought it was cool that you're doing that. So maybe talk about raising the first LP capital. How did you get the first person to write a check or wire money into your bank account to invest in startups on their behalf? What did that look like?
Is it this one? The first AI Go Institutional Fund wasn't really the first one. Or the first a little bit larger one, which was bigger tickets and different types of investors. Well, and I have to say, like, if you're thinking about giving advice to people that are spinning out from established venture capital firms, I think both you and I know that it's quite a different journey if you haven't been at Sequoia, Kleiner Perkins, and you try to build a fund. I realize today that bootstrapping a venture capital fund, like we kind of done, both of us, people don't really do that, right? But it's been an interesting journey for sure. But the thing what we did was we reached out to the wider network, and actually, I think you'll appreciate this. So Ben and I, we were brainstorming because we decided we need to raise a little bit more of a, larger funds and more institutional type funds. And then, we learned a lot of things, and then we need to find a focus. We also need to figure out who will resonate with this. So we actually literally embarked on kind of like a world tour. We actually pinged people in the wider network and community around us and saying, hey, we're going to be in Singapore this day. We're hosting a dinner. We like to meet and get together. So we went to Singapore, Hong Kong, Shanghai, Stockholm, London. We didn't go to Oslo, but Zurich, then New York, and then of course San Francisco. And in that, we went out to the existing network, and people know people, and they like what they heard, and these are people that trust us and know us, that say, well, you know what, I really like what you're planning to do with this fund, and I know you trust you, so you should talk to these people I know. And that way we found our initial group of LPs, basically, right? So going out and just talk to people about what we're trying to achieve, and also listen a lot, what people were interested in being part of, right?
Yeah. And also I think you were, like you said a minute ago, coming up with, as a entrepreneur who had received venture capital, what would I want to see in a venture firm that adds value to me beyond the check that they're writing, right?
Yeah.
And in some of the community you've brought around, and even some of the corporates you brought in, begins to differentiate beyond just Nicolai and Ben of
Yeah.
the identity of the firm.
Yeah, no, I think to me that was really important to, like, that's what, as I mentioned, one of the reasons I'm doing this at all. And actually the humble realization, there's some things I know really, really well. There's a lot of things I don't know. And entrepreneurs we invest in, they need to get access to all the stuff that I don't know, right? So being really humble about that, and how do we solve that equation? So for us, that has been building this community, making it really attractive for some of the super talented people to be really close to us. And that has given us a tremendous sounding board for us at Bootstrap Labs before we even make investments, but also tremendous opportunity for our founders to tap into, get advice and support, and even hire people. And I'm still humbled by some of the people we're working with in this capacity. And like, why do they spend time with us, right? These are, some of the top people in the field in the world. But I realized we through the model, we've been able, with the community, with events and so forth, we've been able to actually give them a lot of value by being close to us. And it's that simple. Like you make sure it's valuable, be more focused on the value you can bring than what you can extract. And, the machine will start spinning, I think. Right?
Sure. And so when did you start investing out of fund one, which with a 2 and 20 pooled LPs, pooled investment model?
So we warehoused the investments in that fund 2016, right?
Okay.
We had a fire fund, like a small super angel fund. We're investing 15, and we started angel investments already then. But the pure AI focused fund, we warehoused a couple of investments that then the formal closing was like in January 2017, right?
So this is interesting to make sure listeners understand this. So VCs have this expression warehouse, like you stick a bunch of stuff in a warehouse, like a chair, a car, and say to people, do you want to buy everything that's warehoused in there? So especially in places like Hong Kong, in my experience, and believe me, I've been to every city you've named many times, out there raising money with good days and bad days. But in Hong Kong, there tends to be this pattern that Hong Kong family offices somehow arrive at the conclusion that they are better at venture capital than I am. And the relationships that I have with you and everybody else that I know going back decades mean nothing. And that they could make a better decision of what deal to invest in, valuation terms, everything. So if you warehouse the deals and show it to the typical investor in Hong Kong, they like that. They like to see what they're getting into, and they don't care where I got my MBA or where you did either, or what you did coding at the age of 4 means nothing to them. They just want to see the deals. So that could be an effective way, in my experience, in Hong Kong. Singapore is much more like, this makes sense. I get it. Nicolai, he shows you his deals. You show him your deals. You're both sharing due diligence, whatever. And, here's the money. Diversify me across those deals, that rather than do the one-on-one. So warehousing is a tactic. I think there's pluses and minuses to it. I mean, one of the things I like about warehousing is that the train is leaving the station. So you want to date me for 9 years before something happens here. These deals in the warehouse will get funded, by the summer at no later than this date. So the train is leaving the station to get into this. And that gives you some sort of legitimate line in the sand.
And the warehousing actually for the first institutional fund was really important to us, much more than I thought when we did it. And it wasn't as much as, and I know what you're saying, some family offices, like they think they pick the deals better, so you're going to look at those. It was just like, well, have you run this type of fund before? No. So what deals will you do? What will it look like? So some LPs that were, quite sophisticated, they didn't really look at it as like, oh, well, I'm gonna, because it's like, what is the sense of, what type of things will you do in your fund? But not only that, what helped us incredibly, we warehoused a couple of deals, small tickets, and we carved out options to invest more. as we closed the fund, and we were pretty, diligent about doing that. And a number of the biggest LPs that came into that first fund never invested with us before. Many of them actually new relationships to us, but some mutual friends, right? So introductions. They actually met some of those founders, so they could ask them, say, well, why do you go to these guys? Why are they your investors, right?
Right.
Some of the warehouse deals we did were, for example, Roger.ai that we sold last year to FleetCor. So two brilliant founders, like serial entrepreneurs. They're incredible, Catherine and Christian, and they're originally from Denmark, but they built another company, in the US, sold it to Cisco called Assemblage, which part of probably the WebRTC stack that we use when we do this right now. Christian invented that, right? So they're like really brilliant people. And we were the first ticket. Like Catherine called me and said, "Hey, Nicolai, we're working on something new," and we invested. And that was because we built a relationship with it. Like, these guys are partners to work with, right? Really, they said, like, we really want to work with you guys on this new thing we're building. So for our LPs to say, well, we already invested in this, and we're going to invest more money from the fund, and they can meet those serial entrepreneurs, really credible. That was really valuable for the LPs from their perspective. Say, oh, this is what the founders think. Like, it's not just talk that
Right.
these, right? So that really helped us, to be honest. That was a big.
Yeah, we started doing SPVs. So, we had deal flow, and we were saying, like, this is not going to sit in a warehouse waiting for you to get your checkbook out if you're slow. Here's your deal right now. Come and see it. Here's our SPV. Don't circumvent us. You won't get in, or try and we'll hear about it. And we were doing that. So that's kind of warehousing. With us, I really don't like warehousing. Myself, I don't like to ask a founder to not fully subscribe their round, waiting for us to solve our problems. But what we've done, and you've met Sato-san, who invested in your fund that we introduced you to, is an example of an LP from Tokyo who comes to visit for a week, and we'll introduce him to our portfolio companies that we're already on the cap table. So we've already funded, and introduce him to friends like yours, saying, I would invest in this fund. Meet my friend Nicolai and Ben. And he gets to meet people and make his own decisions. So when that next opening comes in your fund, he can invest. When the next investment for that startup is, we can put him in an SPV and to invest alongside our fund. So we're calling those like sidecars. So it's not quite warehousing. We've looked at warehousing opportunity funds of saying, look, we're in 75 deals. If you take these 10, that's 250 million, and not even trying to lead the round, but do a real double down, and people can visit some of these guys because we were backing them very, very early. They'll take a meeting with one or two very big LPs that are going to write a $10-20 million check. So I think that kind of warehousing has a little more dignity to it when you funded the guy in his pre-A and his A and his B, and now there's big rounds happening, and they can understand the power of your Singapore network or Japanese network. And, you're kind of adding value to the startup. You're adding value to.
Oh, absolutely.
You're growing your AUM.
There's a lot of issues with warehousing. And one of the biggest issues, of course, that timing with the founders, building enough allocation. You can end up making sure you get too little in the most exciting companies. So there's a lot of challenges. We haven't done warehousing since. But it was helpful for us at the end of the day, just looking back in that first fund. And I know other LPs, even like, some friends that are really, they've been at, really successful, more, established late stage firms. And then like, hey, this is not fun anymore. I want to go early stage. And they built like a large, massive angel portfolio. And then they warehouse, quote unquote, but it's not like they were, piecemeal tickets. They were real tickets, and then they pulled in like 10 companies into the first fund, and that was a no-brainer to just launch the fund with LPs.
Right.
So there's lots of ways to do this. It's kind of interesting as SPVs. I know you've been really successful doing SPVs, and we have been, looking at these, and we ended up saying we're really good at doing late-stage SPVs with our LPs. Most of our LPs actually, they don't really. It's too early. not for them. Like, so B, C stage, we don't really bother with SPVs before then at this point. And what we've done, which you mentioned, I think is, and I think this is really important and a really great model that you've done as well. And you know, we use our events and conferences to a large extent to do this. But so we plan our annual conference, we plan that with our annual LP meeting. So most of our LPs fly in and they stay a whole week and they get to meet all the founders and the ecosystem and so forth. And particularly just for them to meet the founders means that when there's a growth stage SPV a little bit later, then, hey, well, we know those founders, we know who those people are.
That's right. That's exactly right. Yeah, I remember meeting her. I feel emotionally attached. Sometimes I've found out that my favorite event we do of the year is LP only, founders only. And then maybe you do a public inclusive event with, you know, everyone we know and introduce. That's how we introduce our guys to you. But when I find out when we're doing the SPV, they're like, oh yeah, actually, I actually had lunch with the CEO the day after your event and introduced them to them. And I brought them that account. And so I definitely want to be in the next SPV. And it's a totally different. I mean, I always say it's one thing to have a network, but you have to animate the network. You know, what are you doing to animate the network? And sometimes the SPV is even a way of, we send out 2 major long emails to our LPs a year that's exhaustively going through everything. And if they read it or don't, it doesn't really change what they're making. Whereas you send them an SPV memo of saying, hey, by Friday next week, you know, this is it. There's a better chance they're really going to read it and be like, all right, even if I don't invest, you have an ask section that they're asking for introductions to big shipping companies that they can digitize. Well, I have a friend who owns one, you know, so they can make that intro because the network's being animated by that. More likely to get off his butt and do something if they had a glass of wine and, you know, had a barbecue with them. Yeah. So tell us now what your current investment, you know, strategy framework looks like. Like, is AI obviously, but maybe get more specific, stage, geography, where you like to play.
Yeah, absolutely. So we predominantly focus on the Bay Area, the US, like our mandate can go to the US, we can do Canada. We've done one Canadian company throughout the history of our AI funds. But that turned out really well. It was acquired last year. But it's predominantly around the Bay Area. And of course, we're about to finalize the investment today, I think, or tomorrow in with a company in Boston.
Okay.
So yeah, so that gives you a sense. And investment thesis, we, as kind of mentioned, we started to focus on artificial intelligence a bit ahead of all the buzz. So I think we built a great position. We're very active in the field. We have access to a lot of deal flow and talent, but also learned a fair bit of how to invest in a pretty complex technology, right? And what does the team needs to look like to be competitive and all of those things. So we're a very, you know, particular thesis of what we want to see. Our sweet spot to entry is mature seed.
Mature seed.
Mature seed. So it's not a couple people with an idea. We want to see some traction and data points. Sometimes they can have $1 million in annual revenue, sometimes zero. But we look a little bit more on the team's ability to execute on a large vision and the skills to support this. We predominantly tend to like teams where there's depth in both science and in AI, right? So the domain science. So we have companies in the computer vision space, one that went actually public last year, but they're like the founders have, you know, they're ex-NASA, JPL, Lockheed, and they have, you know, degrees in quantum optics and things like that. And then they build deep learning on silicon to build highly optimized sensor systems. So things like that. Or in the health space, where the mental health company, where, you know, there's one of the co-founders has, you know, almost 30 years experience in as a psychologist and design programs for Veterans Affairs and so forth, right? So we have a predisposition for those types of teams. And then we're looking for AI being vertically integrated. So we're less interested in, you know, the toolboxes that need a lot of services to be deployed, but rather the vertical integration, we capture a larger part of the value chain. And there's a few areas, like we look at health, we look at the financial infrastructure, we look at the digital infrastructure of cyber, future work, climate and energy, and then mobility as some of the main areas.
Okay, and so in understanding how mature a company has to be, it could be pre-revenue of the last 12 months. What percentage of your investments were pre-revenue?
So including there's one we did last week that's not announced, and there's one we're doing this week, not yet announced, of course. And then we did so that will be one was pre-revenue out of those three.
Okay, and what has been your investment pace recently? And funds like ours evolve. You know, what you did on your first week on the job may be different than what you're doing now. You learned something the hard way. How many new investments do you make a year, and how many investments are you making a year that are follow-on investments into existing portfolio companies, even from a previous vintage fund of yours?
Yeah, that's I would say that we used to have a slightly higher pace of new portfolio companies than with the current fund. So we saw that we have a pretty high C to A round conversion ratio, right?
Yeah.
Our current funds are not like the prior funds are not at full maturity yet, but we are like 52%, I think, C to A, which is twice the average for the US, and I think we'll hit 60 something before we're done. And with that in mind, what we did with the latest fund was that we actually narrowed the portfolio. So we're deploying a little bit more capital in fewer companies. So that also means we will invest in slightly fewer amount of companies. So I expect it to be maybe 3 new portfolio companies a year, and then we do a lot of follow-on investments in those companies.
Oh, okay. So what's the level of diversification you build into one vintage of a fund?
So it's of course, things when you get into the nitty-gritty details, it gets complicated. But we have a core portfolio, which is actually 15 companies.
15.
We try to build, fairly large ownership in those 15, because we saw that in the best performing companies, we were able to do that in the prior funds. So now we have a little bit more money to actually increase that ownership in the best performing companies. What we do have on top of that is that we do have a pre-seed strategy that's very select, right? And that's like serial entrepreneurs that we invested in before, or we know quite well. And then we have a venture studio model that we have a mandate for in the fund to create 100% proprietary deal flow, tapping into this broader community of talent around thematic areas using AI, right?
So when you and the same LP that's in Fund 3 now is getting into the venture studio stuff as well as everything else. So it's all
funded out of, to make it simple, it's all aligned. So the LPs invest, in the main fund, and then the venture studios are funded from that fund as a feeder strategy. Some of the strategic corporate LPs we are inviting directly to our studios as well. But that's, they need to invest in a main fund to align financially with all the investors.
Okay. And when you start a company incubating with the studio model, what ownership does Bootstrap have at the time that it's founded? Are you recruiting managers to be the CEO in this case?
So we're tapping into the broader community we have of people to become founders in those companies, right? So we map out, certain areas where we see white spots on the map to build something big. And we don't see, our preference is to invest in external deal flow, but if we don't see something that really tacks on some important areas, it's a candidate for doing this. And then we bring in, the serial entrepreneurs in our network, some that sold their companies, we bring them back. Some of them, this becomes a great platform to kind of build a little bit more scale and faster get to building a new company, right? And then the fund takes, large investments, a decently good position in these companies. An investor, the team takes the bulk of it, of course, and then we spin it out and from the studio and keep funding it from the fund.
Okay, so you would own less than 50% at the time that you've recruited the team and funded it.
Oh yeah, the team owns over 50%.
Okay.
But it's a small part of what we do. So it's just a feeder strategy into the main investment.
And as an entry point into a company, so the first time you invest in a company, so it's a new company for you to bring into your overall portfolio, what's the latest stage that you guys are happy to be entering at? How far along?
That is mature seed. We don't really enter after that with the current funds. Yeah.
Okay, so you wouldn't do a Series A as a first bite in. You'd be before A 100% of the time.
The type of companies that we like to invest in, I haven't seen an A round with less than 70 to 90 million dollar pre. Whereas we can, in our mature seed cycle, invest at anywhere between 6 and 12 million dollar pre. And sometimes those A rounds, that markup happens within 18 months, right?
Sure. Well, these
I
days
think we
even
have,
faster, probably.
yeah, sometimes even faster, sometimes 12 months, right? And so I think we found a sweet spot that we think is really attractive. We understand well where we think the risk reward is incredibly compelling, right? That's where we say mature seed. It's not just the wider range and what we call mature seed is, I think, probably what we would call, in terms of risk burn down and so forth, we would call an A round 15 years ago or so.
Yeah. I mean, the funds got bigger after the 01-08 downturns, and what is being called Series A these days would have been a Series B/C in the 90s and the early 2000s. And yet the cost of launching a startup, is gotten cheaper with AWS and all this kind of stuff. You don't need a silicon you don't need a $50,000 SGI box to host your website like I did. I had a Sunbox, but
and the entry-level Silicon Graphics machine, they were $500,000 to run virtual reality, right? So
yeah, that's why it's purple. It's saying this is like the Emperor's box. I remember. Yeah. I mean, I knew guys with SGI boxes on their desks just to be like, I drive a very tacky Bentley. I wouldn't be seen dead driving a Bentley, but it's someone else's jam, right? Well, okay, so let's talk about valuations a little bit. So if a company had 100K of MRR, and so it's a mature seed, or I would call that late seed, before the pandemic, what would the pricing valuation look like on that? And what's it looking like maybe in the peak of 2021? And where are we now on valuation? So share some expertise of where the market is, since you're right on the market for your stage.
Yeah, and I would have to say the round, like the pricing you end up, or the valuation you end up investing is, of course, not only controlled by the market, but also your slice of the market, your specialization, and maybe your position in that market gives you some negotiating power. That's at least what we see. So I think it's not a fair market in that sense. But that said, valuations were definitely rising quickly before the pandemic. And I think to unhealthy levels, in a sense, not only for investors, but also for founders, because, I've been a founder over the years, and if you raise on a too high valuation, that needs to be defended when, there's a lot of value to build into that before your next round and so forth, right? So,
or even exit. Or even an exit, right? So I think things were getting an unhealthy level to some extent. Like when you see a first raise, first money, $40 million at a $100 million post, that's not sound. And I saw some of those popping up on the radar, our intros from people before the pandemic. Okay, great entrepreneurs, but that doesn't make sense, right? Yeah, I mean, they're going to spend that money in 2 years anyway, and they're not ready to hire biz dev people when there's no product yet. I mean, it's just like, it's burned through money and a challenge to even have a flat to up round of the next one, and limited buyers.
And the most, qualified serial entrepreneurs I know, they raise less money in the beginning. They raise what they need to prove out the next set of, milestones and so forth. So all this said, I think, it's going to unhealthy levels. And I think in the first 6 months of the pandemic, a lot of founders that were not well established, they struggled a little bit to raise. That pushed down valuations a little bit. I think they're coming up again. I think people are getting very comfortable making Zoom investments. I think all of us have, we need to figure it out, of course, right? But I still think, like, we have seen these go up and down, and our valuation has not fluctuated that much. I think we have a pretty good average entry point, but I think you need to earn it, right? As a venture capitalist, like money is a commodity, right? So you need to, it's like, the founders need to know why you're there. Why are you a partner for them? And then you can change that conversation a little bit to make sure that, guys, let's maybe have a little bit more sound valuation and then come back and raise a higher valuation. We have more money to deploy.
Yep.
So we try to often work through a little bit of a funding plan until they get to the A round. And that helps managing the valuation a little bit, right? Find a balance where the target ownership for us as a fund and for the founders to not be diluted too much work out. Right?
So when you're investing in a mature seed, are you putting up half the round typically, or are you putting in less than that? Or are you trying to do an in-between round and just do that round and then say on a blended rate?
We typically lead. We are not really good at following. So we typically lead around. Sometimes we co-lead, so lead or co-lead. That means we're anywhere between, the next biggest to the biggest investor in a round, depending on co-lead, like the dynamic varies a little bit. But we're usually in the initial round, one of the bigger investors in a mature seed cycle. And then we have a fair bit of follow-on capital before the A round and in between round investments and so forth.
Okay. Yeah, I think in between rounds makes sense. I like saying to a portfolio company, look, I know you see your friends raising big rounds and you think you should raise a big round. I'm not saying you shouldn't, but if you look at where you're at now, let me just do 2.5 million in right now at this valuation, and you'll get your 20-25 million round in Q4 a hell of a lot easier when you can hire some people, close this, and you can just very low risk raise that next one. And on a blended rate, we're not dead weight, we're bringing a lot more than money to the table. So I like an in-between round.
Yeah.
Look, the big funds, like one thing, Nicolai, you and I have is one of our problems that you and I do not have right now is how to deploy 1.2 billion in 24 months, which is the problem that some of our friends have. And so
that's true.
Writing that check that's doing that in-between round works for us and for the founder, I think sometimes.
I think it worked really well, right? It allows you to balance how much money as a founder you take on with the risk and the validation you have, right? Because overdoing it, I never really seen it work out well, right?
Yeah.
Those are rare circumstances. Right?
Yeah, I like an in-between round. If we made an early investment, there's not a ton of people on the cap table, so we can very efficiently say, let's preempt a round right now, put some money into the company. Anyone who wants to follow has their pro ratas. Let us know what you want. We'll get it done. And then the company can focus on building and not the whole dog and pony dance on a major distraction of a big 20 million fundraise on a valuation that you need to grow into in an inflationary market.
Exactly. So that, they can be focused on execution and actually building value. But also what I tell our founders, like when we come in is you want a partner that is think you are really, really important, right? Like when we come into a company, we don't have that many portfolio companies, right? And the money we come in with is really important for our fund. It's a part, decent piece of the fund, even our first investment. So they all matter. And so for us, like that's our focus. So how do we support them to get to the next level? If you get somebody to run a $1.5 billion fund and they write you a $10 million ticket, it's usually written off when they write the ticket because it's a sourcing strategy. You're not yet important. You're an option for the future. So we tell our founders, like, think of each stage as you grow your company. Find the best partner where you are super important and they're there to support you to get to the next level. I think that's a good way to think about it as a founder.
Yeah, I mean, a $50,000 check from Bessemer is not something they can walk away from without and tarnish their reputation. $100 million investment from Bessemer, that's someone's reputation on the line. Yeah, very, very different, for that specific, investor. So with valuations, give us some kind of answer. What did pre-money? I think you said 6 to 12. What did pre-monies look like in 2019 to 2020 to now? Like, what's a range of what you're seeing on the early
Okay,
side?
so what I can tell you is factually, our average entry point valuation in the first two AI funds, which were kind of fully deployed just before the pandemic, were $11 million entry point average, right?
Okay.
I think we are still close to that. I think it's gone up a little bit. I would estimate, I don't know the exact number, but I would say the things we're doing now with a new fund, we're maybe somewhere between 10 and 15 on average entry point.
Yeah.
But we're also coming in slightly later with a little bit more money. So, but it hasn't moved in reality from the investment we're making that much. It hasn't.
I mean, to challenge that with my set of experience recently, I'm seeing attempts to get higher valuations for seed deals. And then a company with a little bit of traction in revenue starts thinking, oh boy, finally we're here now. Even if they've been working for years and years and years, they get like 3 months of explosive revenue and think time to raise an enormous round to replicate this tiny bit of data. And the valuations have gone really big. And then some of the almost later stage companies thought they were going to repeat the 100 million plus raises of the summer. But all of a sudden we're getting a lot of pushback, and they start saying, we're going to sell 20%. That's constant. And they start reducing the size of the round. And so the valuation was just dropping as much as they were dropping.
Yeah. But as entry point, I'm talking about what I would say absolutely happened, and we're seeing too, is that the curve from late seed into A has become much sharper, right? So the size of the valuation of A round has definitely gone up, especially the things we invest in.
Right.
Right. It's more commonly $70 million plus pre-money on an A round in our companies now than a couple of years ago. For sure.
Yeah. I mean, and like what that really means is that if you invest in a company at a 70 million pre, to make a simple 10x return, you'd have to get liquid at a 700 million exit with zero funding between today and then, which is not going to happen. So not only do you have to exit for 700 million, you really got to be north of $1 billion. And then there's, well, what's the list of companies my banker LP buddies would show this company to exit at a 2 billion or a 1.2 billion, compared to if we could sell it for 250 million. It's just a whole different set of buyers, whole different set of multiples. I think every VC loves making money in a bubble and is secretly wishing for a market correction to, be able to sell the company for a smaller amount of money and make a 50x return. That's more than, a 10x is not enough for early, if you ask me.
I agree.
So talk about bringing corporates into your business. So what do the corporates get from you that maybe they don't get from every other VC fund? And what do the founders get out of this? And how are you practically making communication happen between a corporate and a startup?
So we have a few, we call them strategic investors, strategic LPs, which are larger corporates. And we try to work with them around these thematic areas around AI that we care about. So there's some thought that goes into picking who we work with. And with that, what we try to do is bring a lot of the knowledge or the things we learned on the front lines with doing our constant screening of deal flow and other things. So we do sit down about once a month, or at least once a quarter, a little bit depending, and share a little bit more deeper insights with our strategic investors. So we give them a little bit of a peek into what we learned from our continuous deal flow vetting, and where we realize that our lens as an investor is, of course, extremely narrow, and a lot of the things we see in our deal flow has a lot of value for corporate LPs. Like there's a lot of interesting things where they can engage with pilot opportunities. This might be a great innovation, a great company, but it doesn't fit that narrow investment lens where we think it can, basically return the whole fund at a minimum, which is kind of what you need to go for in my book. So we do share a lot of that, and that's a lot of those strategic LPs. They really appreciate that. And of course, when we're not in a pandemic world, this whole community and the conference and all those things give a lot of access to the broader community and to meet them in person and network and spend a lot of time with the founders in our portfolio is valuable to those types of investors.
And do they do some or all of them operate their own corporate venture capital business units? Are they investing directly in startups too? And this is kind of part of that strategy?
It's actually a little bit different. Some of them have very well built out and thought through corporate venture strategies with allocated money into those. And then they invest in our fund to be able to build better reach, especially we are usually a little bit earlier than them. And we have our specialization in AI field. So that's part of that. Some of them actually don't, and they are building more of a balance sheet investment just to be closer for them to learn more about the AI field and what happens around us and the community.
I mean, there's literally not a single corporate that should not be paying attention to AI right now, right? I mean, everybody's a candidate. Everybody. Campbell Soup.
My message is, if you don't figure this out, you will be gone, right? You'll
Right.
be disrupted and out of business in a not too distant future. So either you figure out how to be part of it and bring that innovation in, acquire companies and inform yourself. And I think, looking at the ones that's the type of things that they're looking for. If they get knowledgeable enough, they will be able to both find targets and know what to look for to start to acquire this type of innovation into the core business.
Yeah. And talk a little bit about what you're seeing in the exit market. So with the world went into shock in March, April of 2020. Where are we now? And what's your lens tell you?
So I think for our specialization, the AI field has been exploding, and I actually see during the pandemic there was a clear uptick of interest from established incumbent companies to buy AI innovation and innovation companies. So we sold 4 companies last year alone from our first AI fund.
Great.
And these are the buyers are predominantly public companies. There was one of the exits was a company that's not yet public but planning to go public. But a few of them were actually, the acquirers were well established, not the Silicon Valley technology innovation companies buying another startup in a earlier cycle, but it was actually incumbent companies like FleetCor acquiring Roger or Pegasystem that acquired Curious. So it's pretty well established companies in their field, right? In payments for FleetCor and call center infrastructure and so forth for Pegasystem.
Okay. And I'll have a closing question for you, unless there's anything else you want to talk about. How do you define AI? I've heard people joke that this is artificial intelligence, like it's not real AI. What's the definition of AI to a black belt expert like yourself?
So first I'll say artificial intelligence is actually not a great term, but it's something that everybody relates to. A better term is, of course, machine learning. But most people don't relate to it. So we're using AI or artificial intelligence for that reason. We can debate this for a long time and say that, well, how can we talk about artificial intelligence if you don't really know what intelligence is, right? But I think I would put it this way. We have enough compute power and knowledge combined, and a lot of the algorithms are not new. We can just throw in a massive amount of compute power on this problem to actually build systems that not only learn, but they can all actually, through reinforcement learning, actually learn by themselves. We basically tell them what are good outcomes and what are bad outcomes. And here's, some information to study upon and figure out and learn from. We're getting closer to the point where the analogy is very close to the fact that we give kids textbooks in school and we try to guide them what's good and what's bad, right? We are training systems, and we're talking about deep learning, which is where it gets really exciting, if you ask me. We can't even afterwards devise how the systems work, right? We actually don't know, really. This is not the computer systems that we use to program where we say, if this, then do that, right? It's not a state machine with rules and algorithms in that sense. We actually need to train them with the data. We can make up the data called synthetic data. That's a massive trend and something to really keep on top of, because that's how you win in the space. We can have another session about that for a couple of hours. But you know, you really need to train the systems and you need to guide them what's good and what's bad. That's how you design these deep learning systems or actually build the models, right? And that's fundamentally different from how we traditionally build computer system or computer software. If that is intelligence, good question. But are we able to replicate cognitive tasks that humans did before, but at unparalleled scale? That also means we're starting to be able to do things or actually empower people with AI or machine learning to do things they couldn't do before. That's not a clear answer, but you know, this is a
no, it's cool.
Yeah.
Yeah, I mean, I was talking to I had one of our, you probably know Kindy, Ryan Welsh from Kindy. It's like there's so much AI in it. It basically could, you know, make Google go bankrupt. Not that this will ever happen, but like the idea of just doing text search compared to this sort of natural language processing and just deep level, it's learning from itself and training on your data. I think of it like when you see one of those movies where you're in that Japanese transformer. So there's like a human inside of this monster thing. And so he's like 100 feet tall and he can punch through walls. It actually makes the human a superhuman, you know, with what they're able to do with that technology compared to how many documents can a human read today and immediately find the interest rate in every single convertible note you invested in 10 years ago. You should be able to like kind of speak to your computer like, hey, find every convertible note with an interest rate, you know, of this. And it goes right through that, you know, what was the share price and how many shares did I invest in that company in 2014? You know, and just like not make mistakes and, you know, just you're a superhuman at that point, right?
And we have a portfolio company that does exactly that, right? It's called Prion.
Prion, Igor Jablokov. Yeah, Igor is an LP in our fund. Yeah. So actually, yeah. He was Igor is the founder of Yap, which was acquired by Amazon. Which when I first met him, he told me we're what was it? Language recognition company. And I'm like, what? Like Dragon Software? That's old news. Then he explained to me what it really was. I'm like, oh damn, dude, that's life changing. He sold it to Amazon, and that became the core of my whole house will start beeping Alexa. So like Alexa wouldn't exist without Igor making Yap. Yeah,
yeah. Alexa, we were the first we were the first investor in Prion.
Well, that's great. That's great. I mean, you're in there with Steve Case, Jim Breyer, all those guys. Yeah. So ironically, the value, you know, he was hiring engineers at such high salaries in the very beginning. And although we're really good friends and I speak to him frequently, we invested in Kindy, which, you know, is a bit of a conflict, but, you know, I love what he's doing. I think that's an amazing company. It deserves to be a multi-billion dollar.
I think it will. I think he's amazing, and the talent that he's able to build around him is out of this world. So there's another one of our portfolio companies that when you were talking them, you know, there's an interesting tidbit here. It's we have a mental health company called Sibley, and they're using a combination of people and machine learning to run their whole, you know, coaching model. That's the core of what they do, built using motivational interviewing. But what's interesting is actually not that and the build scale and all that. Is actually what they figured out was that by introducing machine learning as part of this equation, they were able to actually increase the quality of the mental health care. So it's not just, this is not about scale and so forth. It's actually, you can build consistency that humans really can't do. Like in this field, humans introduce a tremendous amount of bias that can be really destructive for the subjects. Whereas you can use machine learning to mitigate that. And when you build an augmented model of machine learning with humans, it can become incredibly powerful, both scalable and increase quality, but you also get these edge cases that only humans really can deal with, at least today, right?
Yeah. Well, these are examples of we are living in a cave like cavemen, and we're about to go out into the light and become enlightened and stop being cavemen with how we do all these things. But Nicolai, great to see you. I look forward to your next real world event. Give me lots of advance notice. I'll help as much as I can in getting the best people there and speakers and all that jazz. And thanks so much for coming on the podcast, and look forward to co-investing with you some more very soon.
Andrew, thank you so much. My pleasure. Looking forward to talking to you again.
Bye, my friend. Bye.